Welcome to your gold session outlook for Friday, June 5, 2026. In this brief we break down where spot gold stands, the macro forces pulling it in both directions, the technical structure on the chart, and a clear trade map for the day. Spot is hovering near 44.36 an ounce, the weekly bias is bearish to range bound, and the line in the sand is 44.41. Let's get into it. Start with the big picture. Gold is in a pullback, not a top. It trades about 18% below its January record high near $5,400, but it is still up around 35% from a year ago. So this is a correction inside a strong bull market. On one side you have a macro headwind, a hawkish Federal Reserve, a firm dollar, a resilient jobs market, and inflation that is still sticky above 3%. All of that weighs on gold, which pays no yield. On the other side, there is a structural floor. Central banks keep buying record amounts, and that keeps every dip shallow. And sitting on top of everything is the geopolitical wild card, the Strait of Hormuz standoff with Iran, where a single headline can move price in seconds. Here is the snapshot. Spot gold is near $4,436 an ounce. The weekly bias is bearish. The expected daily trading range is roughly 44.41 to 45.10. The pivot, the single most important level today, is 44.41. For context, the January all-time high was around 5,414, and despite the recent pullback gold is still up about 35% year on year. Keep that pivot in mind, because everything in today's trade map hinges on it. Let's score the macro picture across 6 forces. 1. The Federal Reserve. It is hawkish. The Fed held rates with the most internal descents in 34 years, and some officials will not even rule out a hike. That is bearish for gold. 2. Inflation. March consumer prices rose 3.3% year on year, the hottest in nearly 2 years, driven by energy. That is a mixed signal. 3. Jobs. April payrolls came in at 115,000, beating expectations, which is bearish for gold. 4. Growth. First quarter GDP was revised to 1.6%, broadly neutral. 5 and 6 are the supportive forces, geopolitics, with the Iran and Hormuz brinkmanship, and central banks, which bought about 244 tons in the first quarter alone. Now the single most important macro driver, the Fed. The message is higher for longer. At the April meeting, the committee held rates steady, but with the most descents in 34 years. Some members would not even rule out the next move being a hike, given solid growth and sticky inflation. There is also new leadership. Jerome Powell's term ended in mid-May, and Kevin Warsh, seen as a hawk, has taken over as chair. Why does this matter for gold? Because higher real yields raise the opportunity cost of holding an asset that pays you nothing, and a firm dollar makes gold more expensive around the world. The next big catalyst is the June 16 to 17 Fed meeting and its dot plot, just beyond today's session. Let's look closer at the data. On inflation, March consumer prices rose 3.3% from a year earlier, the hottest reading since May 2024, lifted by a roughly 21% jump in gasoline tied to the Middle East conflict. The May inflation report lands just before the June Fed meeting, so it is the swing print for the rest of the month. On jobs, April payrolls rose 115,000, well above the 62,000 expected, and March was revised up to 185,000. A weak May jobs number would be the clearest bullish trigger for gold. And on growth, first quarter GDP was revised to 1.6%, up from the prior quarter but below expectations, which keeps mild stagflation worries simmering in the background. Now the floor under the market, geopolitics and official demand. Earlier this year, US and Israeli strikes on Iran pushed Brent crude above $100 before an April ceasefire. The situation has since become a standoff over the Strait of Hormuz, which keeps a steady safe haven bid in gold and is the single biggest upside wildcard for price. Underneath that, central banks are buying at a record pace. They took in about 244 tons in the first quarter, after more than 800 tons last year. This is a structural shift that began when reserves were frozen in 2022. And private investors are joining in. First quarter demand value surged 74% to a record $193 billion. This is why the pullbacks keep staying shallow. Now to the chart. The structure is corrective. Gold has printed a series of lower highs since the middle of May, with every rally getting rejected in the 45.45 to 45.50 zone. Price is trading below both its 50-day moving average near 45.06 and its rising 200-day average near 46.91. Momentum is soft but not extreme. The daily relative strength index is around 44, just under the neutral 50 line. The MACD is flat near zero on the daily chart and clearly negative on the weekly, and price is hugging the lower Bollinger Band. The read-through is simple: this is a short-term bearish setup inside a longer-term uptrend. It is stretched to the downside, so oversold bounces are likely, but rallies stay sold until 45.50 breaks. Here is the level map for the session. On the upside, the wall is 45.45 to 45.50. That is the major ceiling and the trend pivot. Below it, the top of today's range is 45.10, then the extensions are 45.77, and higher up 46.46 and 47.01. On the downside, the make or break pivot is 44.41. Lose that and the first target is 43.76, then 43.14 near the March lows, and below that a deeper base at 42.55 and 41.86. Treat 44.41 as the line in the sand for the whole day. That brings us to the trade map, 3 scenarios for the day. Scenario A, the highest probability, is bearish continuation. The trigger is a sustained break below 44.41 with a firm dollar and rising yields. The path then runs to 43.76, then 43.14, with a momentum target near 43.51 into next week. Scenario B is a range day. On a quiet headline session, price simply oscillates between 44.41 and 45.10. The tactic there is to fade the extremes, buy tests of support, sell rejections at resistance. Scenario C is the lower probability but high impact bullish reversal. It needs a catalyst, a Hormuz escalation, a soft jobs print, or a dovish surprise, plus a reclaim of 45.10. That opens the door back to 45.50 and beyond. Before the close, here is your watch list. The biggest scheduled event is the May non-farm payrolls report. A soft number would be bullish for gold. Then May inflation, which lands just days before the Fed meeting. A hot, energy-led print keeps the Fed hawkish. The Fed decision itself on June 16th and 17th is the first under Chair Warsh, and its tone is pivotal. On the geopolitical side, keep an eye on any Strait of Hormuz or Iran headline, which is a constant tail risk. And in real time, watch the dollar index, the 10-year Treasury yield, and Brent crude oil, all of which confirm or contradict gold's direction tick by tick. So how do you trade June 5th? The path of least resistance is sideways to lower while gold stays below 45.50 and above 44.41. Treat 44.41 as the line in the sand. Hold it, and the range stays intact. Lose it, and 43.76 and 43.14 come into play. A reclaim of 45.10 and then 45.50 would flip the near-term bias constructive. But remember, structural demand and geopolitics cap the downside, so favor disciplined range tactics over big directional bets into a data-heavy, Fed-bound month. This is educational only, not investment advice, so always manage your own risk. Thanks for watching. If this helped, like and subscribe, and trade safe.